welcome to the Future Ventures podcast on Scaling with Clarity. Today's guest is John Cowan, General Partner at Next Wave Partners, a venture studio and investment firm rethinking how early stage companies are funded and scale. John has spent more than 25 years as a founder, CEO, strategist, and a venture architect. He's become a vocal critic of the traditional venture capital models that prioritize power law returns over sustainable company building. Through Next Wave Partners and his work on Venture Capital 2.0, he's building founder-led capital structures focused on autonomy, infrastructure, and long cycle innovation. Welcome to the stage, John.
Thanks, Maxim. Thanks for having me.
It's an absolute pleasure to be speaking to a fellow Canadian, although living down south.
Yeah, I'm still Canadian by passport, even though it's been quite a while since I've lived there.
Oh, really? You haven't gotten the U.S. passport?
No. I really like my Canadian citizenship, honestly.
Sounds good. Hey, John, why don't we double click on who is John Cowan? Give us the origin story behind you and how did you come into venture?
Sure. Yeah, no, absolutely. Like I said, born and raised in Canada, I sort of discovered the fact that I'm an entrepreneur almost by accident. I began working in early stage businesses in my early 20s, and I gravitated to the job descriptions of figure out what to build, go build it, and then beat the competition. That kind of job description sort of appealed to me. I'm very competitive by nature. I grew up playing hockey in Canada, as most Canadian boys do. So I kind of gravitated to that. I made my way to the United States via the Caribbean. I spent 12 years building an international career between Bermuda and Grand Cayman, and discovered there. I get more of the the behind the scenes, or what I call below the waterline venture architecture and venture building, capital raising, all of those kinds of things that are things that you don't sort of necessarily go to school to learn, but you sort of put those tools in your tool belt along the way, and they've become very, very important assets and skills as I pivoted from building early stage technology companies to helping to scale and finance early stage technology companies under Next Wave.
And when did you start Next Wave? What is the investment thesis? Kind of like what is the focus? What drove you to move from like scaling companies to now? You still help companies scale, but you're not in the driver's seat.
Yeah, not as like the founder or the co-founder of the startup. So my business partner James Thomason and I started Next Wave actually a number of years ago, but it was initially just a home for our research. As technology founders and technologists, broadly speaking, we do a tremendous amount of research. We always saw our job as founders as sort of timing what to build, right? Becoming efficient with figuring out what to build and when to build it, as technology co-founders. So we had a research organization that was really dedicated to that. We both come from, I guess, the same school of thought when it comes to company building and product building, more specifically. And one of the research tracks that we were following, dating back to probably 2017, we got very serious about the future of code, content, and data, and began to really dig into the future of AI as we saw it, while the world was sort of gravitating towards what we all use today now very regularly in LLMs and foundational models. We were more interested in what comes next beyond that. We sort of, it evolved eventually into a full-blown investment thesis, but we were focused on this idea of the era of autonomy. And as researchers and market theorists, we were fascinated with the idea that this era of autonomy, machine to machine or machine economy elements, could actually be that what we call the sixth wave of innovation in society. We could, as analysts and researchers, we could qualify and quantify the five previous sort of like tectonic shifts or massive long arc waves of technology dating back to the origins of the Industrial Revolution. We saw this shift of a machine economy being that significant, and it's rare in the career of venture builders and financiers to live at the very beginning of a long arc of innovation. And when we talk about long arc, we're not talking about cool technologies that come along. We're talking about the foundational things that will shift society, right? Like, we see the era of autonomy, on par with electrification, with the nuclear age, those kinds of things. Like, life as we know it is changing and will be radically different than when we were young. I'm old now. I can say when I was young. My kids, my teenagers, will never really appreciate the era that my generation grew up in. It will be radically not almost. It won't even be an evolution. It'll be radically different. And for good or bad, depending on how you look at it. But either way, we began to really quantify what that meant economically, and like a lot of other changes and shifts in society, there's a significant opportunity for wealth creation. As we move to this machine economy, that research track for us was going on at the same time that we were also analyzing the venture market, and predicting bubbles and predicting the trough of disillusionment, if you will, in technology trends and what have you, is something that we do very regularly also. But this, in 2021, it felt very different. We felt like the industry was about to collapse. And when you take that into consideration, that that venture capital, as I know it, because I've been in this market for a long time, and as my peers know it, is failing. It's not changing. It's literally structurally collapsing around us. When we saw that, that was really for us the decision that it led to the decision that we needed to enter the market with a completely different alternative to what we've been taught to do as founders raising capital. And that was the genesis moment where we pivoted from a research organization to what I call mechanizing Next Wave into a different kind of venture firm built for an era where VCs have, in our opinion, or at least my opinion, have abdicated their responsibility as innovation underwriters.
And I just want to double click on this, kind of like, what are those structural what were the signals that you saw that you were observing in terms of the structural collapsing? Perhaps like the view that you hold it differs perhaps from the rest of the industry.
Well, the structural collapse, honestly, is the root cause of it is this shift in venture capital from being underwriters of innovation. Again, when I started in this industry, venture capitalists became, they were partners with the startup. They got their hands very dirty in trying to help the startup get from point A to point B. After 2009, which sort of, the mortgage market collapse, as well as the birth of, or I will say the acceleration of, software as a service underwriting, and firms like Andreessen Horowitz showing up and saying things like, software is eating the world. I know where I'm putting my money. That whole generation of venture capitalists became, what I would call venture banks, or what Dan Gray, who's a peer of mine in the research world, calls venture banks, where instead of focusing on investing in novel technology that can help change industry and what have you, venture shifted to becoming a business that was genuinely about just raising more money, right? The entire economic system of venture capital, in our opinion, is broken. When I can earn 2%, a 2% fee per year for assets under management, regardless of performance, the motivations of me as a general partner shift from underwriting great technology to simply raising more and bigger funds.
Yeah,
I
of
mean,
course.
it was last year or the year before, Andreessen Horowitz raked $500 million in non-performance related fees. That sounds like a great business. So let's do that, right?
Yeah.
The problem with that is, of course, that you live in that world to fund only the things that can support the narrative of a
Bigger and bigger.
rapidly swelling net asset value of my fund. So when I'm speaking to founders, unless you can convince me that I can spin whatever you're doing into a unicorn, which is another crazy topic, you're not going to receive capital. And of course, our peers on the operator side of the industry, they know the game. We're like rats in the maze. Like we know to tap the machine 3 times to get a pellet of food to fall out. Okay. So we start changing the narrative. Everything is, we're going to be $1 billion company, or we're going to do this, or we're going to, I started this company 6 months ago. I'm going to completely overhaul heavy industry. Like, come on now. Like, but we're conditioned, to speak that way because we know that to get the pellet out of the dispenser from venture capital, that's the narrative that they want to. And for us, like, again, having raised, millions and millions of dollars of venture capital in our own, life and our own career, when the market was sort of collapsing, it was a bit of an epiphany for us. I remember sitting on a call with a founder that I was stewarding and helping, and he was ready now to raise venture capital, and I was about to do what I normally would do, which is make the phone calls and align the meetings and connect venture capital with this founder. And I in almost like a split second, I decided that I wasn't going to do that, and I kind of backed out. I couldn't serve this founder to the wolves. Okay, I just morally, ethically, I couldn't do it. And I told him, I said, look, I can't do this. I can't help you. This is as far as I go. And he was a little bit kind of taken aback by that approach.
Of course.
And what I said, but in my heart and at my core, it was because I knew that I was sending this kid off to his career death. Like I really knew it, because he hasn't lived through 4 cycles of dilution and the ratchets and the controls and the protective provisions and the shit that is going to get layered on top of him by the venture capitalist. But I know it because I've lived it and I've experienced it, and I really like this kid, and I just didn't want to see him suffer like that, even though I could probably make it happen because I've done it before.
Of course. So how do you envision that we solve this information asymmetry? 1 and 2, you often talk about founder aligned capital. What does founder aligned capital mean in your mind?
Well, so when I broke away, like when I felt that feeling of like I just the epiphany moment for me, and not sending that kid down the path of raising venture capital, I immediately sort of went inward. In my own, I became very introspective about everything in venture capital and the experience of founders. I went away for 6 or 7 months and just thought about the problem. And I came out of that with the basis of an essay that I wrote called The Theory of Venture Reciprocity. And what I was kind of focused on is like, why did I and all of my founder peers have this experience with venture capital? It's almost like a love-hate relationship with VCs. On one hand, I wouldn't be where I am in my career without venture capital. I can say that truthfully and honestly. Without speculative capital in my life, in my businesses and what have you, would have no success. But by the same token, I wouldn't be here on this call with you today and talking about this because of venture capital. And what I mean by that is that it's a double-edged sword. It's a double-edged blade. Okay. And kind of getting to the root of that. And when I wrote The Theory of Venture Reciprocity, I came away with the conclusion that our relationship is fundamentally broken from the moment we do an investment transaction. If you're the founder and I'm the investor, our relationship, reciprocity, is predicated on or based on equity. Equity itself is a finite thing. It's like a scarce resource. There's only so much of it, that is sort of in the mountain, if you will. And I, as the investor, want all the equity, and you, as the founder, have all the equity. So
Mm-hmm.
when I started to view our relationship that way, it all made sense. All of the terms and conditions and irrational actions and behaviors and craziness that I lived personally, and some of my peers have lived, more severe than I did, made a ton of sense. Everything is designed to separate the founders from their equity.
Yeah.
Wasserman's data all of a sudden made a huge amount of sense. Like how, a very small fraction of founders survive Series A, and even a smaller, minute percentage of teams and founders, experience, greater than 10% of a liquidity event if they're around to see it.
Mm-hmm.
All of that made a tremendous amount of sense. If I'm a founder, I have all the equity. You're an investor, you want all the equity. So all your terms and conditions are going to be designed to slowly separate me from it. And that's it. That was it. I was like, what? That made sense. And so if you get to that root and then you start thinking in first principles, it's okay. Well, if it's not equity, what is it? And my business partner, James Thomason, came up with a very novel, very clever approach to solve, the reciprocity problem by recentering our relationship around revenue instead of equity. Revenue made a lot of sense to us because revenue's like a magical ingredient in a startup. Okay, so number one, it's theoretically infinite. Right? There's no such thing as my bank account's full, Mr. Customer, stop sending me money. Right? It's theoretically infinite, but it's also the only true proxy for an early stage diligence process. If you built a product and a customer is willing to pay you money for it, it tells the investor at the very foundation that there's something potentially valuable there. There's something there. If somebody wants what you built and they're willing to pay some money for it, it doesn't tell you that it's the greatest thing ever, but it's indicative of potential. Right. So we really liked the idea of recentering the relationship on revenue. And so he wrote a clever instrument called a SAFER, which is the simple agreement for future equity with repurchase. The design of the SAFER instrument is to basically program our return schedule. Like if I give you $1 million and I want $3 million back, that $3 million is going to be returned to me using a small percentage, usually less than 5%, of future potential revenues if and when they ever happen. And that does a couple of things for us as an investor and a couple of things for you as a founder. For you as the founder, it's dilution minimization. I'm staying off of your cap table. I'm staying out of your hair. I'm staying out of the governance. I don't need a board position. I'm not showing up to meetings, as I've literally had in my career with VCs and saying, Maxim, what you should do is you should have more revenue and less expenses. Like none of that bullshit.
You improve the operating margin.
Yeah. Thanks, genius, Captain Obvious. I appreciate the feedback. This is what I'm paying for. Okay. There's none of that. There's none of that baggage. There's none of that overhead. What we want to do is back founders and let founders do what they're convicted to do, what they have the conviction to pursue. And so, so that's a really critical value proposition to founders in the way that we started building ventures and funding them. But for the investor, it's equally important. I always viewed the idea of angel investing as a lost cause, because the return equation, or the value of being the first money and taking the greatest risk didn't equate for me. Right. As an angel investor, I always felt like I'm going to lose my money whether you succeed or not. Okay, so the default is, hey, I'm going to give you $1 million and this is going to go nowhere because we know the success rates of startups. I'm going to lose my money. I'm comfortable with that. I'm comfortable with the risk reward equation, but it actually happens as well on the other side. So let's assume that your business is great and it is going to be a household name or whatever. Well, I'm going to lose my money anyway, because those are the businesses that are going to be swamped with cash from the institutional VCs, who are not using their own capital, by the way, to do this. They're using other people's money. And if they come in with a $100 million investment transaction 5 years from now, and I don't have the balance sheet to invest alongside them to protect my pro rata rights, I'm going to get diluted to nothing. So I'm going to lose my money anyway. So what do I have? I have the value of saying, well, at least I identified that this was going to be something. Like, with all due respect, that's not why we invest. So the idea that we can invest and and structure returns based on the top line performance and success of the
Yeah.
business, and not get into the dilution game or the pro rata game or the ratchet game
Yeah.
or any of that nonsense, that what we call James calls it the VC shenanigans. Like we just stay out of that completely.
Yeah.
And even if the startup wants to raise, if they feel like that, I just have to have institutional venture capital later on, go do it. It doesn't affect our position at all as an investor. It's a very comfortable position, and one where, if you've done any kind of early stage investing at any kind of scale before, you begin to really see the value through compounding. If you're telling me, rather than being locked up for 10 years in a venture fund or a startup that's never going to IPO or potentially never be acquired, I can generate returns in a third of the time on revenue actuality. I understand the importance and criticality of compounding. That money comes back into me. I can recycle it and put it into other things. Right? As an investor, that's what I want. I want that in-out frequency or velocity for my capital. So it's a better position for investors. It's a better position for founders.
For sure. And I mean, I absolutely love the idea. It creates better alignment in terms of where the capital is going. The venture is making money. It solves one of the current problems in venture, in terms of like, your capital is locked in, or if you're private equity, you have money, maybe you're getting some of you're getting dividends, but you don't get paid up capital back. So this provides that optionality, like in terms of getting back. The founder has more skin in the game in terms of like, hey, I maintain more quantity, more equity in the business, so I'm more incentivized to push harder and harder and harder. So with that framing, John, kind of like, can you give me an example of like some of the companies in your portfolio, kind of how you invested, like what kind of the safer instrument looks like for you guys?
Yeah, no, absolutely. So, we started out, when we figured this out and we sort of solved the problem on paper and perfected an instrument legally, the next step was to begin to use it. I mean, we started using it sort of with our own money and making small investments here and there and what have you. And then it became clear that our peers in the investment industry itself, in the finance industry, appreciated exactly what we were doing, and we began to syndicate investment, bringing in co-investors into our projects and what have you. So companies like Surge Networks, if you look at surgenetworks.ai, that is a venture built in conjunction with Next Wave Partners, completely funded internally by us on Safer, and which is really cool, adopted through a crowdfunding platform like WeFunder. Like WeFunder is actually supported, which is, if you don't know WeFunder is one of the top Reg CF crowdfunding portals. They're now fully supporting the Safer instrument, and so our own portfolio company, Surge, was the very first company to raise capital from retail investors buying into Safer, which is a fascinating case study in terms of how that's kind of playing out. We funded companies like tubular.network, using an SPV syndicate, all based on Safer, as an example. These kinds of projects. So for us, like, and it's not just because we're very thesis driven inside of Next Wave. Like, you can apply Safer to any vertical or anything. What we're interested in as a venture builder and a fund is, as I said, the machine economy, like this era of autonomous systems that we see on the long arc horizon. But when we construct a portfolio, what we're really doing is creating a cluster. These things aren't standalone startups that are just on the spreadsheet, if you will. There's an interrelationship, right? There's an interconnectedness. We see, we look for opportunities. And we back in the old days, we used to call it vertically integrated investing. Like, we want, the vertical integration industry, and invest in certain slots in that chain. Very similar strategy as we look down the architecture of autonomy. We know where the opportunities and the problems worth solving exist. And so we look for and find companies that kind of slot into that mosaic, if you will.
It makes sense. What has been, like you said, other venture capital firms have adopted it, say, for as an instrument. What have been the general receptivity of the industry around the safe instrument? And the other thought, the other question I have that I wanted to double click on is, um, on one hand, you have the criticism around the venture industry that they're not underwriting innovation. On the other hand, if I was to put their hat on and say, well, I am only putting money in venture backable companies that have the ability to scale to stratospheric heights.
Mhm.
And so, kind of like, how do you square those two notions?
Sure. Well, so let's unpack that a little bit.
Yeah.
So the idea that I'm backing only companies that I can, that I can see sort of going into the stratosphere or what have you, or becoming the mythical unicorn.
Mm-hmm.
That is an absolutely tiny slice of the market. And let's presume for a moment that unicorns, let's say like the unicorn thesis is an actual viable plan. Well,
Mm-hmm.
there are only a certain number of potential unicorns that can possibly
Yeah.
exist. And
Yeah.
the amount of capital that's chasing them, okay,
Mm-hmm.
it effectively means that, a great percentage of venture firms are not going to be successful.
Mm-hmm.
And that's playing out in real time, right? So if you look at the returns that are being published across our industry, it's pathetic.
Mm-hmm.
It's absolutely pathetic.
Mm-hmm.
Okay. So our perspective is more about the businesses that are not necessarily going to be or must become unicorns.
Unicorn. Yeah.
It's very much. I wrote a paper about this when we started, borrowing from long tail economic theory. So I'm familiar with Anderson, who wrote the Theory of Long Tail Economics, kind of to explain the phenomenon of Amazon. This is like 25 years ago. He wrote the Theory of Long Tail Economics to explain how Amazon was harvesting the tail instead of the head. Like, what made their model work was that they found, in large, because of the internet, that
Yeah.
you could make more money selling the books that weren't the top 10 bestsellers, on the New York Times bestsellers, right? The
Mm-hmm.
tail of a market is bigger than the head if you add it all up.
Mm-hmm. Mm-hmm.
We see the same phenomenon in startup land, right? So all the collective amount of businesses that are great technology businesses that are never going to receive venture capital is a much bigger market than chasing after Anthropic.
Okay.
So while all of the VCs fight over one or two fish and kill each other doing it, we don't enter that market at all. We're over here harvesting fertile ground in territory that these guys are structurally incapable of touching. And this is the exploitation of the innovator's dilemma. So the typical institutional VC is never likely to adopt a safer.
Mm-hmm.
They're never likely to adopt our thinking because it's cannibalistic to them.
Yeah.
Right? It's completely cannibalistic. They will never touch it. And we're good with that. We're okay with that.
Mm-hmm.
The investors that are gravitating to this model are the investors with a DNA profile of, I'm an individual investor that does my own deals one at a time. The family offices that are looking for alternatives to balance out their private security spread in their investment portfolio, as well as LPs in funds that have learned the hard way that the returns are not there, right, in venture allocation. So we're generally not, I've had lots of conversations with VCs, that, I take a little bit of pride in taking out VCs from companies that we covet, because they're extractive by nature. And so, getting rid of it is kind of like, I don't know what I don't want to be over dramatic with my metaphor here or my analogy, but it's almost like curing the startup a little bit of an issue. So we're because we were antithetical to the whole thesis of investing itself. We don't find ourselves in, you won't find us on Sand Hill Road. Let's put it that way.
No, you don't spend majority of your time in Palo Alto.
I used to when I had to raise money, I would have a tin cup and I would go up and down Sand Hill Road begging for money. Working on my pitch to scrape my narrative into something that looks like the VC would back.
Yeah. No, this resonates so well. I don't know if you're familiar with a kind of like a thesis that Maël Gavet, who for a period of 4 or 5 years was the CEO of Techstars came up with, and her thinking was very similar. Let's stop fantasizing about unicorns. Let's obsess over dragons. And the dragon definition for her is like, it's not about how valuable your company is going to be. It's about how profitable your company is, what revenue is going to generate.
That's by the way, that's a in the current VC market, that's a radical idea. That we just focus on businesses that create profit, just based on the fundamental premise of creating product that somebody wants, right, or that somebody needs, and less about putting people in chairs in offices and those kinds of things, as far as use of funds goes. 100% agree with that. But again, that's radical ideology in Silicon Valley.
So if I'm understanding your comments correctly, large VC firms like A16Z or Sequoia, or like the big firms that have billions of assets in their billions of assets under management, they're not keen on the idea. And then the smaller investors that they're more agile, that have a lower risk tolerance, are the ones that are adopting the safer, because they see the alignment, the founder alignment in terms of the capital allocation between an investor and a founder.
And I would say, there's still risk takers. Like, early stage is still very risky no matter what. What I would say is that it's, they're a little bit more experienced and knowledgeable, usually from firsthand experience, about, the nature of, venture fund returns and illiquidity and those kinds of things. And, they're interested in alternatives to that. And so we spend a good amount of our time at Next Wave sort of like deprogramming the power law cult. Right? Like the idea that, and I'll say, power. Okay, let's just talk about power law as a thing. Okay, so at some point, in the evolution of venture capital, and I would say, in the earliest part of the century, the first 10 years, the first decade of the 2000s, we underwent this cultural shift where power law was a mathematical concept to observe statistical paths. We shifted from that to a forward-looking thesis, right? Like, the idea that I'm going to become a casino player, and venture is like roulette, where I just put as many chips on the board as possible and spin the wheel. The industry shifted from trying to explain returns a certain way to actively trying to manifest that, which to us is dysfunctional. It's a dysfunctional way to think about innovation investing in venture capital. So, the investors that are gravitating to the model that we envision, that we've built, and that now that we're operating, are ones that would concur that the idea that I make 10 bets and 9 will fail is an actual thesis, an actual program, is a mistake. And there's a better way to do this, where we can simply, create, let's just say, normal returns more consistently. I don't need the idea. I don't need 100x return investment in order to
make good returns in the fund.
And it's really just a deprogramming of a groupthink that's sort of permeated venture capital over the last 15 or 16 years.
John, you talked about the era of autonomy, like you were heavily focused on autonomous infrastructure. What does the world look like over the next decade? Kind of like, where are you placing bets? What are you excited about? Kind of like, if you were to kind of like go through a Merlin exercise for the world, like 5-10 years out, what does this look like?
Infrastructure. It's infrastructure.
So
I recently wrote a book, which I'm going to share with you, because I would love your genuine feedback before it gets released. The book is called National Infrastructure Notes: Financing the Machine Economy. America's a Machine Economy. And the part of the central to the thesis of the book is that we are in the very beginning stage of a long arc of innovation that is not unlike what the titans of the rail industry saw 150 years ago.
Yep.
Okay,
Yep.
and so when we think about the like if you think about like Vanderbilt and Carnegie
Yep.
and the titans of industry of that era of the rail industry, they didn't invest in rail because rail was a profitable technology or a
Yep.
innovative technology. They invested in rail because they understood that mode of long form transportation was going to radically overhaul the economy, and
Yeah.
they made their fortunes by investing in the economies that formed around rail, the industries, the cities, the towns, the real estate, the land, all of it, right?
Mm-hmm.
That's the play. And we see the same thing taking shape now, revolving around, intelligent and sustainable infrastructure. This country is going to require trillions of dollars of new, innovative, intelligent, sustainable infrastructure deployments. I'm not talking about roads and bridges and data centers. I'm talking about the fully decarbonized, intelligent, sustainable infrastructure that will underpin all of this machine to machine stuff
Mm-hmm.
that people write about and fantasize about
Mm-hmm.
in our industry. So we're keenly focused and interested in the strategies to underwrite risk in financing new innovative infrastructure, physical infrastructure, right?
So, is it fair to say that you're focused on the technologies that are going to bring this infrastructure in play, or the physical assets, the physical infrastructure
Both,
assets?
both.
Both. Okay.
Yes, 100%. Yeah. So if you look at the project that we co-founded at Surge Networks, that is all about proliferating the physical infrastructure at ground level in urban environments that are
Mm-hmm.
necessary to produce all of this intelligence, like
Mm-hmm.
physical things, physical infrastructure. Not, I mean, software is important, but the software is irrelevant if the sensors and the compute and the devices and what have you are not present in the environment, right?
Mm-hmm.
And what that also does, when I put my portfolio builder hat on for a moment as a venture capitalist, I also pay close attention then to the software and the technologies that are being built, the deep tech that's being built and engineered to solve some of these challenges at a transaction level, so that that feeds our strategy of what to invest in, whether it's, if you look at a company like Cron AI, which we invested in, which has done amazing innovation in the field of 3D perception, or companies like we've backed, like Adaptive Swarm, which took precision, what we call micro precision navigation technology that was originally designed for the military, that we're beginning to apply in urban cases, because like the future of if you think your Amazon drone delivery is going to be pinpoint accurate in a big downtown market like Atlanta without precision navigation, you don't understand how this works. GPS is not going to suffice. So we're investing in the technologies at a venture level over here, but then investing in the build out and the owning and operating of infrastructure at a ground level.
Yeah. And we're seeing this across kind of like our interactions with portfolio companies, with investors, that there's a significantly high interest into deep tech. Before, it was glorified, kind of the businesses that don't have physical assets, like the Airbnbs of the world. And now it's like people are looking at companies that have defensibilities and moats.
Yes.
And so, can you? One thing that you've said in some of your other speaking engagements is like, real estate is the new API. Can you unpack this?
Sorry, you broke up there. Can you ask that question one more time?
Previously, you've said that the real estate is the new
Yes.
API.
Yes.
Can you unpack this?
Yeah. So real estate is the new platform. So if I am thinking about, I'll use the example of our own portfolio company at Surge. So I can own all the infrastructure I want, but if I have nowhere to put it physically, right, it's kind of pointless. So we speak to private and public real estate owner operators, not from the perspective of tenant and rent, but more from the perspective of your real estate is the platform, right? If you have, and so we focus on rights of way partnership, both publicly and privately, for physical infrastructure of all kinds, right? That's what I mean by that. So it traditionally the real estate operator was a fairly analog business. It was not really tech focused. I mean, they bought technologies and they tried to automate. They do automate, a lot about real estate management and real estate development and what have you. But what we're talking about is more or less viewing the real estate landscape, like how much physical real estate that you have, as a platform for hosting and operating the next generation infrastructure, sustainable infrastructure. And what that does is it shifts the mindset of real estate from again simple tenant rent extraction business models to long-term appreciable revenue participation in the generation of data, for instance, that serves all of these AI models that comes from real estate. That's kind of what we're getting at with that. It's a shift in how we think about and view physical real estate, or what we would call like the rights of way, public and private rights of way for physical infrastructure.
Makes sense. What are most investors still missing about edge AI and intelligent infrastructure?
I think again we're still. I mean, I'll just say the market, because I'm saying the majority of folks in the market, are focused on what we see and observe and use today. Like that AI is it's Gemini and Claude and OpenAI, ChatGPT, these kinds of things. And that's not untrue. It's just that market is already kind of it's being served, if you will, right? So looking a little bit beyond that, what happens in the AI landscape beyond these foundational models, that's really where, again, if you're an investor in this space, I would urge you to spend your research cycles on that, as opposed to the apps that are going to get built on top of Claude or something.
Yeah, I completely agree. We recently had a founder from a really cool company. His name is Nikola Borisov, and his company is called Deep Inference. So essentially, he's offering inference as a service. So, I mean, I think that companies like that will scale significantly, because that would be a significant need.
Yeah. So part of our forward-looking thesis is that these intelligence systems, the AI models, if you will, are going to require an ever-growing source of real information, right? In order to continue to grow. And one of the places that we see the greatest amount of potential data that feeds those learning models is what we would call edge, what we would call the Internet of Things. It's sensors and devices deployed in the field that are creating data that ultimately needs to make its way back to these intelligence engines, right? So doing inference at the edge and processing data that becomes part of a larger intelligence system is a unique and what we would describe as a compelling investment opportunity. Right.
It's interesting that you say this. I believe the professor was Ross Perron out of the University of Adelaide. He had done a study around oil and gas companies and kind of like comparing the super majors, like the Shells, the Exxons of the world, vis-a-vis the services companies. And so from a pure value accretion perspective, the services companies have accreted a lot more than the actual companies with the underlying assets. And the data that was pointing there is that they were not using their own data. They were using data that was generated by the super majors, but they had used this data to then drive value around it. So it was really interesting. Now, AI is extremely powerful when data exists. And yes, I agree. If you have centers, you can accumulate Internet of Things data. But what if you don't have data? Kind of like, how do you go about acquiring the data?
Well, and this is part of what we believe needs to be built. Is this we can call it an API, but let's just call it the data interchange between where data is produced, where information is created, and ultimately where it is ingested and processed and made discoverable and usable by the plurality of interested parties. that architecture, that infrastructure is really yet to be built. Like the connection between, the true machine to machine data that exists at let's say a street level, and the foundational models that help process that information and turn it into actionable or usable intelligence. So that that today that technology, that facility does not really exist, right? It's something that there are a number of players that are working on solutions to that. They call it different things, but it's something that we are keenly interested in, because we know that, again, that, quote, that API to the real estate, if you will, is a critical building block to feed these engines, to feed this intelligence layer.
Just pulling on that string, are the next generation of transformative companies more likely to come from outside traditional VC hubs?
Yeah, 100%. In fact, and we track this too. Making and we track this from the perspective of Next Wave being a more of a global participant in this. And I wrote a theory called Geographic Alpha a couple of years ago, and it's based on the idea that you want to structure your practice around taking advantage of what each individual region might provide, for whatever it provides for its specific value. And since sort of practicing that theory, what we've seen are a number of what I would call very dramatically underserved regions, even in the United States, dramatically underserved regions that are producing amazing technology and amazing scientists, but are never going to raise venture capital out of Silicon Valley, right? Because of the traditional way that we used to concentrate. The prototype of Silicon Valley was this primordial soup of big technology companies, universities, and money and capital. Everyone's trying. We think about trying to replicate these hubs, and structures. And the reality is, given the way that we operate, given the way that we work as human beings, given the way that we develop as human beings, we don't think that that's required anymore. Right? I can run a completely distributed team between New Delhi and San Francisco if I want to. And take advantage of different regions for their different purposes. And when we started to look at the market with that lens and that approach, we began to discover pockets globally, even that we would never have thought about before, right? I'm
curious, and where are you seeing this geographic alpha?
I'll tell you. So we see a tremendous amount of innovation coming out of markets in Florida, for instance, that we never would have looked at. We're seeing innovation come out of international markets as well, like Switzerland as an example, that we never would have really considered in the past. We are seeing opportunities in Latin America that again it would have come across my desk before, and I would have said, I don't think so, that's never going to work. But now because we look at this lens more from harvesting alpha geographically, it doesn't, like, we like the idea that these underserved markets exist because it's for a venture investor, it's fertile territory. Like this is the land where no one's planted crops. Let's go plant crops there, right?
I mean, we have an office in Buenos Aires, and we're seeing the same thing in Latin America. Just right, and not all America-based companies can be easily scaled into Latin America just because of either culture or business norms or whatever it might be, or different regulations. So we're seeing that alpha there. The other place that has really surprised us, but this is based on primary evidence in terms of working with companies, is the Scandinavians, the Nordic countries. One thing that we learned from one of the founders is that in Norway, there's 9 times more startups per capita than in Israel. I'm like, really? He's like, yeah. So there's this like pockets of the world that they're very surprising.
So we've spent what we started to do as a practice also too is create bridges to markets. So Indian companies that are trying to create U.S. presence, U.S. operations, U.S. companies that are trying to export to other countries, to open up different markets. We spend a lot of our time on that level of strategy as well, because we think about the market now less by regional hubs and more by unique opportunities that exist at a global level. So it doesn't surprise me about the Scandinavian countries, but I would just say 10 years ago we as investors and operators were just really powerless to really do anything about that. It would be just an interesting stat or an interesting fact. Now and again we at Next Wave we've structured things internationally, so we can work with investors that are outside of the United States, and we can work with startups that are outside of the United States, and both from a tactical perspective, but also from like a regulatory standpoint as well.
Yeah. What does the venture capital industry look like in 10 years if the current trends continue?
Yeah, I think it's going to whether our individual approach to the problem ends up being correct, or the model or what have you. I don't think really that's the point. But what I do think is that we're going to see a retreat to smaller fund sizes and more hands-on venture building. And by hands-on venture building, I mean being involved in the startups to fill critical gaps, to help accelerate the success of the portfolio company more directly, as opposed to this passive allocation private equity model. I think we're going to see a renaissance, if you will, in venture capital that focuses more on collective venture building than passive investment finance.
So if I was to characterize that, I'm actually looking for your kind of like shaping here, but is it a fund that's like 50 to 100 million, maybe 1-2 GPs? Is it a combination of a venture capital firm and a venture studio? Kind of like what does the ideal venture capital firm of the future look like?
Okay, so I literally just wrote about this. I called them coalition funds.
Okay.
When a coalition fund, is a structure that I wrote about this because I've formed them and I've seen them operate now. Yeah. And I think it's going to be a central theme as part of this renaissance in venture building. The idea of a coalition fund is, I call it a venture fund with no passive GP manager. So it's accomplishing a couple of different things. So on one level, the traditional venture fund, the traditional GP raises capital from LPs and really puts the LP in a box. And these LPs, in my experience, are usually very, very interesting, innovative, connected, and helpful people. Because if you have enough capital to be an LP in the fund, you've had success doing something.
Of course. Yeah.
And that success could be very useful and valuable to startups. Okay. But generally, VCs put that in a box, and you're only just a capital source to the venture fund. You might be on the investment committee, or you might have some passive view into what's going on, but you're generally powerless. Okay. In that structure. And part of the reason why that exists is because the GP depends on a 20% carried interest in their fund economics, right? Like, I'm the oracle, and so I create all the value, and therefore my 20% of all your profit is justified. The concept of the coalition vehicle gets rid of that middle. So you eliminate the carried interest model completely, and you diffuse the governance and operation of the vehicle itself across a small number of participating LPs, the coalition, who bring different a variety of different intangibles to the table. Okay. And we at Next Wave, we recognized this trend and set up the plumbing and architecture to help accelerate and facilitate those things. Right. So, we operate an exempt reporting advisor service explicitly for that, right? To be able to help facilitate these coalitions to form and capitalize and invest into whatever projects that they companies that they've deemed worthy of their time and capital. So that the idea of venture investing without a passive GP, I think is going to be a fascinating trend to watch. It's taking advantage of it's really cultivating the trend of LPs and allocators being tired of the traditional 2-20 fee structure, while again still also reverting or moving back toward the idea of active venture building as opposed to passive capital allocation.
Interesting. John, I know we're coming on time. Any kind of parting thoughts, words of wisdom, anything that you've learned over the last 45 years?
Yeah, oh my God, we need a little bit more time.
Another hour?
Closing another hour. We could go into all kinds of case studies and examples and share stories and compare scars. We could do that for a lot more than an hour, I would say. But I would just say, look, if you're a founder that is trying to raise capital, or you are an investor that wants to have some exposure to private securities and early stage innovation, I would just encourage you to reach out and get involved in the dialogue. Change happens because a whole variety of people get involved in the discourse, and that's really what I would invite.
Out of curiosity question, have you had any conversations with ILPA, the Institutional Limited Partners Association, and kind of like what is their perspective on kind of some of the vision and direction that you're having?
I haven't, because a lot of those organizations are made up of the classic
VC firms,
institutional LPs, the endowments and the retirement savings, the pension funds, those are really aren't. That's really not the audience for what we're talking about here, right? It's more the individuals. So we find those conversations taking place more in smaller communities, smaller groups.
Got it. If people want to follow your work, get in touch. Nextwave.partners, LinkedIn.
Nextwave.partners is sort of like that's the 9 to 5, if you will. I publish all of my independent research on johncowan.io, which is it revolves around the book I published last year called Venture Capital 2.0, building, financing, and scaling startups in the post-power law era. And I write and publish very frequently via that site.
Very nice.
Where I don't really have a filter on that site. So if you want unfiltered take on our industry and what's happening, that's where you find it.
johncowan.io. When does the new book come out?
It's going to come out. It's going to come out imminently. Like I said, I want to share a copy with you because I would really love your candid feedback on it. I'm gathering sort of feedback and thoughts from people that and professionals that I know are in the industry and are concerned about this topic, about infrastructure and what have you. But I depending on that process, sometime in the next couple of months, I think you'll be able to find it on Amazon. But when we're done here, you're getting a
I need to have you back,
an EPUB copy of it.
Yeah, for sure. No, that'd be amazing. Thanks, John. That was a fantastic conversation. Very, very insightful thoughts coming from you. So I appreciate you taking the time to speak to our audience.
Thanks for having me, Max. I really appreciate the opportunity to talk about these things. Again, just try to encourage the discourse in our industry.
Of course. Thanks.